Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Dan Bell from HiFX with our weekly look at the currencies markets, the Never a Dull Moment report. This is our last one for the year, so we thought we'd do something a bit different and look ahead to 2013. So Dan's going to give us 5 key themes to watch out for in the currencies markets next year. So Dan, what's your first one?
Well, the first one for me is really keeping an eye on US monetary policy. And as we know, US monetary policy has been a key driver of global markets over the last few years. And as we know, the US have been printing money through their quantitative easing program. Just recently they announced another round of treasury purchases, and they've got this mortgage-backed securities purchases that is essentially open-ended. But at the most recent Fed statement, they've put an unemployment rate and an inflation target on their stimulus measures. And I think that's really important, because what they're saying is that if unemployment gets to 6.5%, they will start to remove some of the stimulus. And I think the really interesting takeout from that is that the market will not wait for the unemployment rate to get to 6.5% to start pricing that in. If we do see a meaningful improvement in US unemployment and in jobs growth, I think you'll start to see the market anticipate the Fed removing some of that stimulus, and that will be, I think, very important for the US dollar and for global currencies in general. And will in fact see the US dollar strengthen against most major currencies. As we know, the market has the saying, don't fight the Fed. So in this environment, everyone has been selling the US dollar, or more inclined to sell the US dollar. The New Zealand dollar, as we know, traded to a 12-month high last week around 84.75. But I think next year, if we do see employment improve in the US, it's going to be a different story. And I don't think the conditions to keep the New Zealand dollar on this uptrend are going to remain in place.
And your second thing to watch is all around the New Zealand-Australian dollar cross.
Yeah, again, I mean, we're looking at the New Zealand-Aussie cross rate as extremely important for New Zealand. As we know, Australia is New Zealand's largest trading partner. Some analysts have recently come out to predict that Australia will cut their cash rate next year to a low of 2%. Now, their cash rate is currently set at 3%, so actually higher than our cash rate. If the RBA was to cut the cash rate to 2%, I think you will see quite a significant drop in the Australian dollar against the New Zealand dollar. Potentially we could see the Kiwi-Aussie cross rate up over 85 cents. If you look at the 10-year average in the Kiwi-Aussie cross rate, it is closer to around 84 cents. So at the moment we're trading just a shade under 80 cents. I think that will have a big impact on our export competitiveness into Australia, and also on our own central bank's policy, because naturally if the Reserve Bank of Australia is cutting interest rates and our central bank are either keeping rates steady at 2.5 or potentially talking about raising interest rates, we're going to see the New Zealand dollar rally significantly. So that's going to be a major concern for the central bank and for our economy next year.
Yeah, that's certainly one to watch. And how about a number 3?
Well, again, looking at the New Zealand dollar on a trade-weighted basis. Now, there's a few things happening in the New Zealand economy which are considered sort of good news stories. We've got the Christchurch rebuild, we've got the sort of housing market. I don't know if you want to call that a good news story, but it is providing some form of stimulus to the economy. So on that basis, our central bank does have a challenge next year. So the New Zealand dollar, from a trade-weighted point of view, could in fact be one of the strongest currencies in the world. So the challenge there is even if we weaken against the US dollar, the weighting against the Australian dollar, the euro, the Japanese yen and the pound, which are still quite major trading partners of ours, could have quite a significant impact on the trade-weighted index. And as we know, the Kiwi on a trade-weighted basis was up at the same levels as when the Reserve Bank intervened back in 2007. So if we see the Kiwi-Aussie cross rate continuing to go up, that trade-weighted index is going to look even worse, and potentially that might have an impact on our central bank policy as well.
Yeah, there's plenty, obviously, to keep Reserve Bank Governor Graham Wheeler awake at night, isn't there?
Well, there is, and I mean, you're looking around the world. Japan, obviously, they've just got a new leadership in place. They are committed to trying to weaken the Japanese yen. We know that in the UK, for example, they've still got their own sort of money printing program in place. In the US, I mean, whilst the US may well start to remove some of the stimulus at some stage in the next sort of 12 to 24 months, they're still printing money. Europe have got their own sort of form of balance sheet expansion. So we're sitting here as global central banks debase their currency, keep interest rates low, and print their own dollars. We're in a situation where the New Zealand dollar could continue to go up, and that's no one really wants a strong currency at this particular time.
And how about number 4?
Number 4, European woes to continue. So
really?
They continue to kick the can down the road in Europe. The euro's been quite strong over the last few weeks against a lot of currencies, and I think that's due to positioning more than anything. I think this time of year you're starting to see traders square up, and the euro's benefited from that. But the reality is Europe is expected to remain in a recession next year. And I think the political challenges across that region will continue to be a problem for them. So austerity isn't working. We've still got huge unemployment rates across the region. We're not seeing enough growth. So I think Europe has still got a lot of challenges next year.
A lot more pain to come. And how about number 5?
Number 5, thinking about the critical role that governments and central banks will play in the global economy next year. And as we know, the US are currently going through this negotiation about their fiscal cliff. I think they're going to get it sorted. I mean, a lot of the negotiations are occurring behind closed doors at the moment. I think they'd be absolutely stupid not to get it sorted, because everyone knows that the US will enter another recession if they don't. So I think they're going to get there. So that's the first major government or political issue that we're facing. We mentioned obviously the ongoing issues in Europe. We've seen a leadership change in Japan and China. I think you could start to see governments talk about protectionist issues and how global central banks are having an impact on currencies and on trade flows. So governments will continue to play quite a critical role next year, and it's whether our government or our central bank actually want to perhaps be a little bit more proactive about how they manage and assist the New Zealand economy to get to where we need to be, as opposed to letting the market do what it needs to do, because we're pushing against a bunch of interventionist policies really from other central banks and governments, which is making it very difficult for us to be in a better spot for our economy to grow.
I mean, obviously that would have to be a sea change, both from the government here and what we've seen from Graham Wheeler thus far. I mean, it's very much the orthodox, old-style inflation targeting governor that he appears to be, and certainly the National League government doesn't really want to join these newfangled ways of addressing the currency, does it?
That's right. I mean, in a perfect world, it would be better if everyone was letting the market dictate the value of a currency, or have an impact on their economy. But even Australia, with the forecast for Australia's cash rate next year, it's showing you that the Reserve Bank of Australia have realised that if they don't give the rest of their economy a break by bringing down the cash rate and ultimately bringing down the Australian dollar, with the mining and resources sector having peaked pretty much this year, then their economy has got some major challenges next year as well. So I certainly don't have any answers for them, but they've got a challenging job next year, and I think the currency is going to be a big part of that.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz, and just like to wish all of our viewers a Merry Christmas and Happy New Year, and we'll see you in 2013.